Shall we begin with the main economic news? You saw this morning China promising to fire back against the Trump tariffs. Are we in a trade war? Are we in a huge game of chicken? Or is this just a sideshow from your point of view?
I'll let you know. I mean, the problem is that how many times can you be on the edge of your seat waiting for the shoe to drop, it doesn't drop, and how many times can you get that anxious about it? I would say, I don't know if this is going to be the pattern of North Korea, a lot of bluster. I don't think we're in a suicide pact on this, so I suspect that we're not going to cause the economies to collapse with a, smooth hauling on steroids. But I do think that, so I don't think that's what's going on. I do think, as some people have commented, that this is kind of a negotiating pattern. That would be my best take.
And you went to China with Trump all those months ago. You disappointed with his China policy?
Well, I met him in China. There was a trade mission, and I'll have to say, let me give credit. It didn't occur to us to go on the trade mission. I got called up by the White House and said, do you guys have a pending transaction that's near enough to close that we could close it as part of our trade mission to China? And I just said, no, we don't. And I got a call back, and we have a lot of things going on in China. I got a call back from them a couple of weeks later, just before, not like I was looking for an extra trip to China, and they said, remember what we asked you? It turns out, yes, you do. The Chinese said you do. And so we went there, and in fact, we closed an important transaction that I want to, which is a kind of a joint venture between ourselves and the Sovereign Wealth Fund of China to go out and each raise an amount of money, put it in our managed private equity fund, and invest in U.S. businesses that will be able to export into China. So this was an early effort, symbolic in the scheme of the whole level of U.S. trade, but an important symbol of what China wanted to do to spur U.S. trade.
Do you think China's attitude has changed? Back then, China seemed to be looking outward. They were doing things like the deal with you. And now suddenly, they are retaliating at the moment, certainly in terms of rhetoric.
I think the whole thing with China is there's a lot of frustration with China from here. I know that China is very frustrated with the sudden aggressiveness of U.S. policy. But anybody who has transacted with China appreciates the potential of China, has had good experiences in China and frustrating experiences in China. And at various times, one or the other comes to the fore. We ourselves, to be quite honest, 15 years ago almost, set up our joint venture in China that was to lead to us being able to own our own investment bank in China, which seemed imminent at the time. And there have been a lot of suggestions that that was going to happen very quickly, and in fact, statements that said it's already available. And then oftentimes that gets announced at the senior-most level, and when it gets into the ministries that have to affect these things, we found out recently that now, these many years later, that in order to own our own entity, it has to be capitalized at a level that would make it totally not sensible for us to do it, and so we feel back at square one. That level, again, we're in finance, but we're advisors to people in other industries, and other industries have similar experiences. And again, this would not be the course I would have done, not necessarily recommend, but I could see what happens at times. A lot of the people who are expressing too publicly, this is a very difficult thing. Americans, this is a very bad thing, which of course we know from taking economic courses that it is at the end of the day. And publicly making these statements because they do business in China, and you have to pay homage to your clients in China and your customers in China. And at the same time, when they're not in public, could very well be going to the U.S. government and saying, something, what you're doing may not be such a bad thing. And so I can understand how we get to the place that we get to.
But do you see the argument that was maybe acceptable at $50 billion worth of tariffs, but now you've got $200 billion and you've got the prospect of a full-blown, it's gone beyond.
Again,
the game of chicken has got.
It's not my style, but if what you want to show is if you want to give somebody an incentive to see the world from your point of view, it doesn't help to remind them of your negotiating position if it's a better one. And the fact is, if we go tit for tat, by the time you get to 100, they run out of things to apply a tariff to, and we don't. And so if you want to make that point, you make that point. Now, that's what you would do if you were crazy and really wanted to end free trade. And that's what you would do if it was a negotiating position and you wanted to remind your negotiating counterparty of just how much firepower you had to bring to the negotiation. Which one is it? You know.
But do you think Donald Trump is a protectionist? He disliked NAFTA. He has this long record.
Well, remember Rosencrantz and Guildenstern play this. You can't even play this flute. How could you play me? Who am I to say what he thinks? He doesn't. I don't know what he would do, what I would do in his place, and I'm not sure. Certainly not sure what he would do in his place. But if you ask me, can I give a narrative about how this is a useful thing to do, I can't say, as a lot of people do with respect to almost everything he does, this makes no sense at all. It does not make no sense to me at all.
Okay. If you look around the world at the moment, you have what we just talked about. You've got the China situation, you've got Italy, it would seem hell-bent on challenging the Eurozone. You've got Brexit, you've got Argentina, you've got Turkey, you've got the possibility of a populist of Mexico. You've got all these things, and yet the markets just seem to shrug their shoulders. Is political risk not really a factor?
Well, two things. You could separate them, talk about the risk. A lot of the risk in the world today, or a concentration, there's a lot of risks in the world, but a big concentration of risk today, is sovereign risk. You know, we're looking at the politics, but you can look at, the economic situation. A lot of the, if you look at it, a lot of the leverage in the world that was with the banks didn't disappear from the world. They migrated over to the sovereign. So you see that the sovereign in the U.S., we have a $4.5 trillion balance sheet. You look at Euro, similar amounts. Japan, similar amounts. $15 trillion of debt on sovereign balance sheets, that the banks are deleveraged, but now the risks are with the sovereign. And
does any of those particular sovereigns worry you? I suppose Italy would be the one.
Well, of course, for a variety of reasons. One, it's got huge amount of debt. The debt might be big. The debt might be big for its partners. In 2011, when there was a sovereign debt crisis in Southern Europe, the issue was, is there the willingness of the ECB, i.e., is there the willingness of Germany to sort this out and to back it up, to back up this Southern Europe situation? Now, those lines never converged. The sovereign debt of these Southern European countries, especially Italy, had continued to widen out. They were getting an interest rate subsidy for being connected to Germany, but they didn't deploy that to reduce their debt. And so I think at this point now the question is not the willingness, but the capacity to do it. Now, one thing about the U.S., it's sovereign. U.S., we print the money we borrow in. Japan prints the money it borrows in. There's a lot of risk and consequences to printing too much money, but that's not necessarily a systemic moment. It'll cause inflation if you overprint too much money, but that's not exactly going off a cliff. On the other hand, in Europe, everybody borrows in a foreign currency. Italy doesn't print euros. Yeah. It doesn't borrow in lira anymore. It borrows in euros. So it's always more worrisome how one would deal with that. And of course, there are rules that the countries in Europe use to protect their fiscal policy. And again, I would say that issue, and obviously immigration, are the big risks to the whole construct of Europe at this point.
You see Italy as the biggest sort of sovereign threat.
Well, it was in the news yesterday, but look, it is, and also because of its size, and that was there for a while, but also because more recently of their election of a more, populist,
an unusual coalition.
Well, getting more usual all the time.
Yeah.
If you look at what happened obviously in Central Europe, might even say what happened in the United States, the weakness of Mrs. Merkel in Germany, you're getting again, I don't want to merge these two things, but the financial risks of these countries, and also the kind of immigration issue, which creates some stress on the establishment governments, which feed into the financial, financial crisis, and that creates the geopolitical risk that we see.
Do you see this, especially what's happening to Merkel at the moment? Do you see this wave of populism sweeping around the world linked to immigration? And have you
well, I think it happens. Look, we're seeing this in the United States now on our southern border, where obviously, horrible, tragic situations, but it's an immigration issue that splits, the immigration debate has split the country, and more realistically, in Europe, and more, dramatically and consequentially in the near term, the immigration issue in Europe, where magnanimously, you'd say, Germany admitted a couple of million people. One would say the right thing, but hard cases make bad law. And of course, with open borders in Europe, Brexit is a direct link to the consequence, I think, as a consequences to the immigration crisis. They're talking about a soft Brexit. If you get at the soft Brexit that people are now speaking of, the only thing that Britain will have accomplished in Brexit is the immigration matter. And you look at the populism in these states, what's going on in Italy, and certainly the relatively right-wing movements in Central Europe, those are reactions to immigration questions.
There's an interesting balance, though. On the one hand, don't get me
wrong, hard cases make bad law, because I wouldn't want to be in the position we find our government now with respect to the tragedy that's going on the border.
You wouldn't know which to choose out of...
Well, I would say I couldn't do it. I couldn't do what obviously is being done now, so I agree with all the things. But when you watch TV and you listen to the pundits, I don't hear anybody talking about the consequences. How long would it take for millions of people to appear on our southern border if we permitted it and permitted people to pass through? The same thing that happened. You saw the tragedy and the consequence of what was happening along the Mediterranean. And again, you learn this, one of the cliches of law school, hard cases make bad law. When you want something, when it appeals to you and to your heart, and you make something work out as a matter of your sense of justice as opposed to a rational progression, you can end up with a hard case but bad law.
Do you think that politics is much harder than business? I mean, all these people from Goldman went into the White House. It was sort of like the House of Lords for ex-Goldman employees. Now, all the friends of yours did that. Now they've come back. You look at those sort of decisions which they make, people like Merkel, people like Trump, do you just think that is much harder than the sort of decisions that business people have to make?
Look, we can change our mind. We do things, some days I do things out of the public eye, some things I do things in the public eye. I just think the consequences, and again, when I watch, the punditry, it's all right. And look, again, let me establish, what we're watching now is heart-rendering, and again, I wouldn't be on that side, but thank God I'm not there, because I would, in my role, and certainly in government, where you have to make these choices. Look, it's never right against wrong, good against evil. The issues are always right against right. Now, what do you want to do? Both sides are right. Could you you admit millions of people into Germany, and what happens? The European construct that worked for 60, 70 years, which arguably ended a pattern of every generation warfare, that is put at risk by immigration. Is that right to do? No. Is it right to leave people, babies strewn on beaches? Of course not. You know what the right thing to do? Both sides. What do you want to do? So I would say what's hard, it's easy to criticize, and it's easy to say what you would do if you didn't have to bear the consequences for what you decided. But when you have to bear the consequences, and you have to realize that there are adverse consequences on both sides, that's what's really tough. And I have a lot of sympathy on the one hand, but appreciation for the decision making. And when something doesn't quite work out right, I don't want to kill the person that made the decision.
And does that put you off any idea of having a later career in public life?
No, because I can't imagine being more miserable than I was made to feel outside of public life, so why not? But no, I don't
There's a fashion for financiers of your age to run for mayor of New York City. That would be
somebody put that out there, and they said, I said, Oh, no, I would be mayor of New York City. I don't know if I'd run for mayor of New York City.
What about, okay, I'll take that as a no. But all the same, on the general impression you get, it's interesting. You seem relatively sanguine about the markets and the economy, but you've just run through all these political risks.
I have a lot more.
The idea that Italy could get into trouble, Brexit, all these different things, Trump, trade wars, and yet the markets just say...
How about rate rise? How about rising interest rates, which usually have an effect on valuation?
How high do you think interest rates can go in this country? A question for Marty Feldman.
How high can they go? I mean, I lived through... when I got out of school, short-term government interest rates were in the teens and not the low teens. By the way, while inflation was also above 10%. By the way, while unemployment was above 10%. So these things can happen. I know everybody's debating, and the hands, lips are quivering. Is the Fed going to raise 3 times this year or 4 times this year and next year? I remember sitting, 94, I remember Fed raising 50 basis points between meetings. Yes. So I don't think people are braced for what the potential is if the Fed feels that it gets beyond the curve, and what would be the consequences of that. And just think, every bond that's been bought since interest rates have been low and trending low for so long, everybody wants higher interest rates, so you'll have a higher return. But don't forget, every instrument in anybody's portfolio will then drop in value. And whether you mark to market or not, it will be worth less. And just think of all the assets in the world that are priced off of a discount model. How about real estate and almost everything else? And you think what happened with to the finances of the world and the economies of the world, because when you had a dramatic and unexpected and rapid drop in real estate prices, well, I would think the fall off in, a rapid rise in interest rates, unexpected, would have even a more dramatic. Is this my base case? No. But I'm in the business of risk management, and I'm forced to spend about 98% of my time worrying about the 2% of the things that would go wrong, and I could occupy more than the time you have here to tell you the things that I have to worry about.
There's another strange thing about that, is that out of the many areas that people worry about, one is consumer.
By the way, I'm optimistic.
Yeah, no, you're making.
So I'm just saying, I'm wallowing in the 2% at this point.
You just terrified everyone here that.
No, I live in terror. I live in a state of terror, so that's all right.
I'll come back to that. But in the basic idea, you have just, many people would say consumer debt is one of the first things which should get hit by higher interest rates. I think
Did I say
New York.
That?
Well, it would probably get. New York Fed has just said there's $13.2 trillion worth of consumer debt, and yet that's the field that Goldman's chosen to go into expand. You're trying to hit consumer debt, personal finance, that sort of area. Does that make sense at this stage of the cycle?
Well, we intend to be in business through, I don't know how long this cycle lasts, and we intend to be good risk managers in this business through all the cycles. We're not going to time in and get into and out of businesses that are franchise businesses for a cycle. We're going to acclimate our risk and how we lend and our protocols and our profile to what we feel the market is. But let me just say, just as a predicate, the predicate in your question is, in a way, we're going into the consumer business, but not so much that we're chasing a consumer business that's so foreign to us, which consumer business generally is foreign to Goldman Sachs, a wholesale and institutional firm. But really what's happened as a result of movements in technology, the opportunity in the consumer space has moved to us. If you're lending to 500 people, the kind of decision-making you'd make in consumer lending, it's like, Jimmy Stewart in It's a Wonderful Life. You look into somebody's soul, your neighbor, and you're a good credit, you're an honest person, I'll lend you that much money, Mrs. So-and-so. But if you're lending to 50 million people, it's math, it's algorithms, it's macro risk management, which is the stuff we're kind of good at and have been good at for a very long time. And if they're not your neighbors, but they're coming to you online, then it's digital delivery and digital platforms, which we're kind of good at and we've done for a long time. There obviously is a big customer experience to this, and we have to import that into the firm. But a lot of the risk management decisions that are making, the distribution decisions, the algorithms, that one would go into making these kind of decisions kind of is in our wheelhouse. And one of the reasons why that represents a big opportunity for us is that we don't have legacy stores. We don't have thousands and thousands of branches that we have to protect on the one hand, and the normal disruptors in this space, the Silicon Valley crowd that would normally come into this space, aren't licensed deposit takers and don't have balance sheets and really can't do it. They have to kind of jerry-rig and securitize these loans and have to make them all kind of the same so they can be securitized. And so there's a very good opportunity. It's very rare that you get a big bank like ours that doesn't have a legacy consumer business that needs to be protected.
Just challenge you on one thing. It just being math is, it strikes me that Goldman at the moment, you deal with lots of big companies. Sometimes you have to say no to them. In this particular case, if things do go down, if things change, you've got, I think, up to 20% subprime. It's going to be normal people in houses who you're going to have to say, look, we need the money back. And this is going to be a different, going back to what you said earlier, this is going to be a different political.
What we're doing so far is unsecured lending. So if they lose money and they don't want to pay us back, there's no house to repossess, no car to take over. So that would be, we made a poor risk decision.
But you feel happy with, I suppose...
I won't feel happy if they don't pay us back.
Yeah, obviously. What about the last... Hank Paulson came here.
But we're still assuming that there are people who will be caring about their credit ratings and their positions, and people tend to pay back when they can. And we'll have to make the right macro risk decision. Again, to make a judgment about one person of 500 people, it's a very sketchy thing. It's easier to make a judgment about 50 million people, how 50 million people will act, the law of large numbers.
I suppose what I'm saying is if the politics come back, you see all these banks who had to go through the hell of 2008, 2009, which you did in a very different way, but this particular one will, if it does go bad again in consumer debt, this is something where people will, I don't know, use images of which may not be as helpful.
Well, I will tell you, we will be the ones that will suffer because, again, these are not mortgages on people's homes or secured lending. If they don't pay us back,
you're right.
We'll be the ones on TV that you'll feel sorry for.
That is possible. Hank Paulson.
Obviously, by the way, we have other consumer verticals too, and there's more to be rolled out in this space. But it looks very attractive. And again, it's the migration of the opportunity, not us trying to be what we otherwise would have been 10 years had we chased this business 10 years ago.
Come back to Goldman in a second. Hank Paulson apparently came to this room and said in 2013, that you should expect a financial crisis every 8 years.
Me personally?
No, not you, but we could have told you that. He probably told you that already.
Yes, he has.
But do you think that's about, does it feel as if there is another financial crisis in the works somewhere? You said consumer debt you're happy with, sovereign debt you're worried about. Where do you look?
Not necessarily.
When you get worried?
We had them periodically. It's obviously more than 8 years since the last one. In Europe, people, for a few hundred years, people were told to expect a war every generation, and it hasn't happened. So I look for these things. I don't think the mere passage of time causes it. You need, in the metaphor, you need kindling on the floor of the forest. You need some things, you need leverage, some things that could blow up, and then you need the spark that would blow up.
What are the signs you look for? What are the bits?
Too much leverage, bad behavior, in the context of the last financial crisis, bad origination practices. And then, of course, the spark could be some macro event, some default that happens, a bad play by the sovereign, bad fiscal policy, a bad monetary policy would be the spark. But something that, if in a period of time in which there wasn't, again, this kindling, wasn't this leverage or this opportunity, might pass unnoticed, but at a time when it was ripe for it, would cause it. And I would say if you were looking for some signs now, your earnings are good, you're not really seeing the kind of leverage, but maybe you don't see the leverage until after the fact, and you look back and you say, aha, it was there and I didn't know it. I'd say credit seems relatively easy. But on the other hand, it's not remotely close to the leverage that one would have, people like us would have financed in the run-up to the 2007-2008 crisis in terms of the transactions. So you don't see it. Look, you don't see the things you can't see. The reason why these things become bubbles is they're not easily seen. The advantage of your job versus my job is I have a P&L and I can't remember having seen it. You can always claim to have seen it.
Yes, well, that's the advantage. You do get some other benefits from what you do. In terms of that, you look back at that period, what do you...
Sometimes it's even worth it.
I know,
not
exactly.
always.
In terms of that period, that you've now got a long time to reflect on it, what's the thing you think you did badly during that crunch, and what's the thing you think you did best?
I think the worst thing we did, look, our risk management was pretty good. We participated in the market for real estate. I mean, the crisis was of real estate. Real estate prices went down, and that was the crisis. Real estate went down, and all the debt in the world that was collateralized by real estate went down as a result. And that was 95% of it. So on the risk management, we didn't know what would happen. We bought stuff, we sold stuff. We basically ran a balanced book. The crisis was really two halves for us. It was the existential part. Did you lose a lot of money? Do you have existential risk? Could you be insolvent? Which we navigated very well. And then the reputational part of it. For having navigated it pretty well, it went from how did you do it, admiringly, to how did you do it? You mean when you were hedging, you sold things to people? You must have known, should have known, blah, 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 and therefore you were, we didn't make money in the financial crisis, we didn't lose money in those years, but we lost a lot of reputation in those years, and a lot was inflicted on us. And I think the thing we did the worst at, was underappreciating. We were a wholesale firm. We never advertised in the life. We didn't have our name on our building. We moved to a new building. I'm thinking of putting our name on our old building now. But the other people, if they have some sort of crisis, they change the copy of their ads and they go out and they talk to their customers. But we took the position always, we had the view, keep our name out of the paper, put our customers to the forefront. We represent them in M&A, but it's really not us to get the attention. We had no real advertising budget at all. And it turns out that, all those, another name, we didn't have a consumer business, but other names for consumers are taxpayers and citizens. And so we had an important, all of a sudden we discovered that they discovered they had a relationship with us. We had a big effect on them. And of course, we discovered they had a big effect on us. Not because they were consumers and we were a bank, but because of their role as taxpayers and consumers and our position in the financial system as a very big influential firm that was influential in the context of financial crisis that affected everybody. And so that was an adjustment that we had to make very quickly. Prior to the financial crisis, I never would have appeared at anything. No, my predecessors certainly didn't, and it wouldn't have occurred to me. And I realized that if you don't describe what you do and help define yourself, you'll have left a vacuum that someone will very easily define and describe for you. And so that was a very important lesson. And then I learned a lot of little lessons for crisis management that I never expected to need to know.
And if you looked at finance now through the eyes of those stakeholders, I suppose would be the way of describing them, like consumers, taxpayers, do you think that the government has represented their interests well? You've had all this role of regulation.
Well, regulation, and I think the most important regulation and the most important role is the way that the banking system has been deleveraged forcibly and aggressively. And even though it looked in some cases like a medieval fair with all these noises and hearings at the end of everything, and people around the world would watch this stuff and dismay about this public display, at the end of the day, the U.S. did it. The regulators did it. People will write dissertations, in the tranquility of some carol in some library about they should have done this, they shouldn't have done that, and they got it wrong. But at the end of the day, almost in the heat of battle, they did all this stuff and it got done. And the stress tests were done in such an aggressive way, and let me tell you, I was the focus of a lot of the aggression, but were done in such a way that there was no issue about whether it was convincing from the point of view whether it was just soft or whether it was real, and it actually persuaded the credit world that this was real and that the banks were creditworthy. something that in some parts of Europe are still not quite certain, many years later. And so I'd say regulation, which of course, in my point of view, and the view of a lot of people, was thrown together very quickly, and there's time for an adjustment, not to repeal it, but to adjust things
What's the bit you would most like to get rid of?
There's things about VOCA rule, there's a lot of redundancy, there's leverage tests, and, there was supposed to be a catch-all bank up to, you're supposed to have capital related to the riskiness of the assets on your balance sheet, and then there was a general worry that maybe we weren't assessing riskiness the right way, because in the financial crisis, we underestimated the riskiness of certain mortgage assets. So in addition to using a normal test of leverage based upon the risk of your assets, let's have a general catch-all where we don't assess riskiness of assets. We'll just look at all the assets on your balance sheet, including dollars in banks. And that was supposed to be a catch-all to make sure that nobody, kind of the tax version of an alternative tax, if you will. Well, it got to the point where that catch-all is now the binding constraint, and it was never intended. So those things have to be adjusted. VOCA rule, which was added kind of as in addition to making sure that people had capital against their risky assets and you were able to wind down an institution that was failing. VOCA imported a state of mind test. What was the reason why you engaged in that transaction? To support a client's business, or because somebody wanted to buy low and sell higher? In the real world, people aren't really thinking that way. They're kind of market making and doing that. And so that's been a little bit counterproductive, because the regulators in turn put the bias, we'll assume everything is for a bad purpose unless you prove your state of mind was for a near-term expectation of a client flow. It created, for a time, the bulk of our IT was set to provide metrics that would prove that. And it was actually interfering with the safety and soundness of the system, because it didn't contribute safety and soundness. So there's things like that it kind of, I think, everyone recognizes have to be changed. Some people don't want to get into any changes for fear that if you open it up, you'll wreck everything. And, but I think, after the way this was put together and after a period of living with it, I think there's room for some adjustment. But I don't want to get away from lauding the regulators at the time and the people in the public sector for the way they handled the war that was in the fog of war and the aftermath. And all you have to do is juxtapose how the U.S. financial system has responded, how quickly that regained its footing compared to compared to our counterparties in Europe.
There's another thing going on at the moment that people look and they say, look at money. Money has gone increasingly into the sort of darker areas of finance or away from public markets. It's gone, towards Bitcoin and cryptocurrencies on one hand, but it's also gone towards private equity, venture capital, away from public companies. Is that a trend that is going to continue?
That's a real problem for all of us. And that didn't obviously start with the financial crisis. There was Sarbanes-Oxley, which was a big contributor to that.
But it's been increased.
Look at the anguishing that you're seeing in the press now for where Aramco is going to list. In other words, we have, in an effort to make our markets pristine, which is a laudatory goal, and complex, and the litigation standards, it is, I will tell you, not everything about being a public company CEO is as attractive it must look to you.
How would you change? But how would you change it? Because it is a real structural shift.
You make it tougher and tougher and tougher, and companies won't want to be public. And so all of a sudden you'll get a two-track system where you'll have very, very tough regulation on companies that are public company, and increasingly companies that defer going public, with the consequence that their investors are not remotely as well protected, and possibly a Theranos. And so what do you want? And so I'm saying, by the way, this is something, and again, I didn't use the example I used per se, but this is something that the chairman of the SEC said. There are half as many, the number of public companies in the States, half is what they want. Is that a good, I mean, if we wanted to really toughen up and 5 public companies and everybody else was dealing in private markets, and we increased the liquidity available to private markets, would we have accomplished safety and soundness objectives of the system? No. And so I'm not arguing for a collapse and abandonment of systems, but, you know, one should do a cost-benefit analysis of some kind on whatever incremental benefit you're getting compared to the burdens and the cost you're putting on the system.
Do you think Goldman could go back, and would Goldman have worked better if it was an old-style partnership?
I think parts of our business, but it's not something we can recriminate about or wring our hands. We could not have stayed public with who we were in the financial system. We could have elected, in order, the way the world evolved, we started out as an advisor, but in order to be an effective advisor, you had to be able to give effect to the advice you were giving. So I could tell you should do this merger. I should tell you you could do this financing. I could tell you should grow your business in this way. But to be an effective advisor, I had to put capital on the table for you or your benefit or help you raise it so that you could achieve that objective that you and I would agree was our good advice. If we were merely advice givers, we could have had a very important role in the system. There are a lot of great investment bank boutiques. They do very well. They don't have 90% of the problems or issues I have in my life as somebody who runs Goldman Sachs. On the other hand, they're not as important in a lot of ways. They're not the influential institutions that we are. And we decided as a firm that we liked the position that we had as a very, very important institution and driver of growth and change in the financial system and the evolution of business. We liked who we were, and in order to do that, we had to have a balance sheet, and in order to have a balance sheet, we had to have permanent capital, and to do that, we had to go public.
How does Wall Street change?
And we were the last public ones to go public.
How does Wall Street change over the next 5, 10 years? To pick on one thing, people here have asked about cryptocurrencies. Does that become a real issue or not? Are you worried about them? You've put your toe in the water.
I worry, not really in any kind of systemic way. The people, it'd be very painful for somebody who put his or her entire net worth into cryptocurrencies, but it's not a systemic issue at this point. People are passionate for it, passionate against it. I remember when they came out first with, when they came out with cell phones, I remember thinking, God, who the hell is going to lug this thing around?
Yeah.
And I'm saying, and besides, there's 10 phone booths on every corner. I'm not going to, this is a fad. Nobody's going to carry a cell phone. So I just passed on that whole thing. Turns out to have worked. So now they have cryptocurrency. And I always thought, I can't say why it should work. But if it did work, I'd be able to explain it in hindsight why it did. Because
that has been your secret to success. Bro.
Yeah, well, you have to look at things from both sides and say, sometimes in a risk thing, I say, will this happen? What are the chances of it happened? And sometimes I find it easier to think about something, okay, let me postulate, this did happen, tell me why it did. And I find that it's sometimes an easier way of seeing it. And I look at the evolution of money and I say, you start out with gold as money, and people only take hard currency, and you make gold coins, and a gold coin was like $5 if it had $5 of gold, and eventually they would give you a piece of paper with the promise that there was $5 in gold to back the $5 piece of paper, and you could go in and redeem it. Then they gave you a piece of paper and said there's $5 of gold, but you can't redeem it. And at some point they give you a paper and says it's worth $5, we're not going to redeem it, and we don't even have the $5 even if you wanted to. And we're still doing that today, and I see that morphing. And I'm saying that if you could go through that morphing, if you could go through that fiat currency, where they say this is worth what it's worth because the government says it is, why couldn't you have a consensus currency? And so it's not for me, I don't do it, I own no Bitcoin. Yeah. Goldman Sachs, as far as I know, unless nobody told me, has no Bitcoin. But if it does work out, I could give you the historical path why that could have happened. And so I'm not in the school of saying, gee, because it's uncomfortable with me, because it's unfamiliar, this can happen. That's too arrogant.
What about something completely different, which many people should say should happen, is that no woman has run a big Wall Street company. I think you did something yesterday where you set up a $500 million initiative to help sort of women fund managers. But I think you say amongst the people, out of the possibilities to succeed you at Goldman, there wasn't an obvious woman. Only 5 out of the 31 on your management committee are like that. Explain to me, looking back in 5 years' time, whether there will be a woman running a big Wall Street firm.
5 years' time?
And explain it.
You know, other firms have more senior women. You know, sometimes we've had very senior women. People take different career paths. The most senior woman at Goldman Sachs was the person who ran our until 3 days, until the end of this month, because it's a resignation. And it's sometimes people have to work harder at this and get it done. And we're working very, very hard at this. And you're right, there's nobody who is that proximate. Other firms may have different experiences. Certainly our metrics in some cases, senior women partners at the highest level, but at that absolute highest level, sad to say, and blame, and some of it is fortune and where people have put themselves or taken themselves. This is not a unique problem to any of us, but that said, it's a problem. People are going to have to work harder at this, and we're trying different ways of doing it.
People could say it is a problem generally for Wall Street.
No, of course it is. No, it's a problem generally for business as a whole, and you can look way outside of business too. It's a problem for institutions. It's a problem in walks of life. To have more of an equivalence between the demographics of the country, and it's a gender issue, and it's not just a gender issue. And nobody wants to explain it away because there's no explanation, and it looks like you're trying to be exculpatory if you try. So let's just say we all have to work harder at this, and we try various things. You're about to point out to a fund that we're committing to that will invest in startups for women-managed venture funds. We have other programs that are like this that support women's initiatives, women in the workplace initiatives, and we have, again, a very good record sponsoring, a very good record of bringing women into the firm, and like everyone else, a very poor record of bringing people into the top leadership position in the firm.
What else? You've worked in finance all this time, as Terry pointed out. What has been the biggest thing that has changed in those 36 very quick years?
Well, obviously when I started, because that was a long time ago, that was a generation and a half ago, the big thing I would have said at the beginning of my career was globalization, which sounds like a quaint term now, and something that has now gone through its cycle that we're all trying to kill. People are now hostile. That's gone full cycle. But when I came into the firm, and I came into the foreign exchange department, we could not issue a confirm in sterling or in any currency other than $1. It didn't print it. Yeah. And so I rode the crest of the wave of globalization. Now, in the last 15 years, it's the crest of the wave of digitalization and technology. And today, if you want to price on an equity or an instrument, 98, 99%, it could be 100% of the prices that we make on a mark-to-market basis are made by algorithms that are made systemically. It's not just distributed that way. The prices are made off of inputs that are input digitally. And that's a kind of a new phenomenon. I'll tell you another observation is that the decision-making, of course, there's judgment in this, but the decision is being made by programmers and software experts, and not and a lot of times I look at somebody, what used to be called judgment, oh, that's a judgment decision, saying, oh, judgment decision, that's just a few million extra lines of code. Because eventually you can...
Doesn't that frighten you?
In a variety of ways, of course it does. By the way, it creates an interesting phenomenon. Look at the same thing for Uber. You're going to have drivers, and gee, why did you drive through that stoplight and into that storefront and injure those people instead of swerving into that wall and killing yourself? Well, you would say, I didn't know, I didn't think so, it was a natural instinct, I couldn't help, it just happened the way it happened, and it's all a blur to me. It won't be a blur. Some programmer is going to say, if you see, if you see that wall, drive into the wall, or it won't say that. And they'll come back and they say, why didn't you drive into that wall instead of into that storefront and risk more lives than your own? And those are things that are going to happen. What did you take into consideration when you made that risk judgment? Well, let me subpoena your software and your lines of code and see exactly what you anticipated to have done in this situation. So it's an interesting set of phenomenons.
I'm sure there's an investment banking equivalent of driving into the wall. But
there is, of course there is.
But just
that's the point I'm making.
But putting that to one side.
Having driven into several myself.
But the other effect of technology is that people can, in a sense, work anywhere. Computers can be based anywhere. You're doing stuff in Salt Lake City. This is the economic club of New York. How does New York prosper in this new age of algorithms? Does it still retain its position? What do you worry about from a New York perspective?
Well, it turns out, remember, the world is flat. Everybody will go to the lowest cost place, and so you'll work out of some place on the steppes of Central Europe, Central Asia, and it doesn't work that way. There was this book. I think Richard Florida, it turns out that people in the kind of creative class like to live amongst each other. They like to go to the theater. They like to aggregate together. And of course, it's not going to be a world of automatons. There's going to be creation and things. And by the way, even though the lines of code have to be written, there's not going to be and the people who create and the people who get together and the people who engage are going to want to aggregate together. And there's a lot. New York has had quite a head start on aggregating together all people who are like that, and has the infrastructure that tends to attract more people who are like that, and those people attract each other. And so I tend not to worry about New York as long as they don't keep making it so very expensive to be here versus other very, very attractive places.
If you became mayor, that would all be solved. If you became mayor, you could solve that problem.
Well, I would say if I advocated moving out of New York, it would really hurt my chances.
Lloyd Blankfein, thank you very much.
Oh, thank you very much.
Thank you.